B. Ramesh, welcome back to Bazaar Morning Call. Well, B. Ramesh Babu of Karur Vysya Bank is joining in now to talk about their numbers and the way forward. Sir, thank you so much for joining us. Appreciate your time here. I want to first start by, the top line growth, the NII growth, which was quite on the weaker side. Is the incremental cost of funds coming in at a higher rate than the incremental yield on advances? And I want to understand, going forward, is this weakness something that can continue on the NII front?
Yeah, good morning, Sonia. In fact, this financial year is one of the historic years for the bank because many of the key parameters under the business growth, asset quality and profitability, there are many parameters are decadal high. So now coming to the NII, what you mentioned, so it's pretty good. In fact, we have seen our NIM, which is at 4.19, so which is as per our expectations. So we have rebalanced the portfolio, and many of the corporates we have reduced it low yielding, and that we have moved into our commercial, which is a high yielding segment. So that way, while I agree with you, the cost of deposits is going up. Now what we see is it's more or less plateaued, and the next 3 to 6 months, if the liquidity is quite okay, so there may not be any need for us to increase the time deposit rates also, and lot of flows are coming. If you can look at our time deposits growth is 21%, it is more or less in the last 10 years is the highest. So that way liquidity, depending upon the liquidity, the cost will go up. Otherwise, we are on a safe track.
Okay, so this net interest margins, right? Can you tell us what are the sustainable net interest margins going forward? You're sitting at about 4.2%. In FY25, where do you think your margins would be?
If the rate cut is not there, so maybe in the first 6 months, we can expect around 4. It will continue. So that should not be an issue. And provided the liquidity is also okay and there is no much need to hike the rates to get the deposits. If that is there, it will have some sort of a bearing. But whatever it is, even if those sort of eventualities come up also, so it may be between 3.8 to 4. Otherwise, we feel that around 4 we can sustain in the first half year.
All right. Hi, Mr. Babu. Good morning. So we take that point on the NIMs. What about loan growth? Could you tell us, since you have repositioned or rejigged your portfolio, as you mentioned, went a little bit slow on the corporate side. Okay. What is the overall loan growth that you're guiding for? And within retail, which segment are you more positive on?
Yeah, Mr. Nigel, in fact, if you look at it, our retail has picked up a lot. RAM, if you look at it, commercial is at 21% and retail is at 18% and agriculture is 17%. So all these three engines are doing pretty well. The question is whether we can feed the same amount of raw material what they require through liabilities. So if we can raise the CASA deposits accordingly, so loan growth should not be a problem at all. So that is the reason conservatively what we have guided is, so minimum of 14%. Last year too we have guided a 14%, but finally we landed at 16 plus 2.5. What we have shed consciously on account of low yielding 1600 crores during this year, so it has come to 18.5. So that way now loan growth is not a big problem, provided if you have the proper texture and a mix of deposits.
Okay, give us a few more numbers then. We've got the loan growth, we've got the NIMs out of the way. What about guidance on the gross NPAs as well as credit costs for the coming fiscal?
Yeah, gross NPA and net NPA, if you look at it, so these are decadal low. And our SMA, that is DPD 30 plus, if you look at it, it is less than 300 crores on an advances portfolio of around 74,000 crores. So this consciously we have made a lot of effort through collections and follow-up, and this has come to the stage when our DPD itself is around 300 crores. We don't expect a great slippages from this. That is the reason what we thought our slippage ratio can be around 0.75, something like that. And our credit cost also can be 0.6 to 0.75. That way it can go up. And beyond that, we don't expect that there are any shocks will be there as far as asset quality is concerned.
Okay, no shocks in terms of asset quality. I'll come to the guidance in a bit, but on the gold loan front, I mean, overall loan growth was weak, but even on the gold loan side, you have been struggling a bit. What is the way forward and what kind of average growth can you do?
Struggling in the sense that what consciously we did, high value gold loans, whichever are there, we consciously shed them and we granularize those things also. And second thing also, we thought of looking at the LTV. So gold prices have gone up. Suddenly there is a crash in that. We should not be caught on the wrong foot. That is the reason we brought down. Now, if you can look at our LTV, it is around 67%. That way, though 75% RBI has permitted, we are a bit cautious on that, not growing aggressively. But still, if you can look at it, lot of growth has come up in the jewel loan segment. We also diversified into other agricultural segments like MFI also we are doing, and other agri also, direct agri we are doing. So that way we want to diversify our portfolio rather than totally concentrating on the jewel loan for the agri.
Okay. All right, sir, thank you for being with us, and appreciate your comments here on the business and the way forward. All the best for the quarters to come. Let's do one thing, that is Karur Vysya Bank and